Hello, everyone, and welcome to our first monthly webinar. Just allow me a minute to double check if everything's working well, if you can hear me properly, and let me just connect us to our IG's platform. And if you can please hear us properly, let me know on the chat. So this is Farah Murad, UAE's market analyst at IG Group. The idea here is simple. At the end of every month, we step back, we look at what actually moved markets, identify the major drivers, we highlight the hot assets, and then we try to position ourselves for what's next. So it's not only about the headlines, it's not only about the technical analysis, it's about understanding the flow behind it. Today we will do three things. We will wrap up what February was really about. We break down key movers. Definitely it was the equities, the S&P, Dow Jones, Nasdaq. Then we look at gold and silver and oil and also Bitcoin. But also this is a live session, so if you have any questions, please do let us know. Let me check as well if the chat is working properly. And I'm not really sure if the chat is clear. Okay. Um, okay, I think everything is clear. Everyone can hear us well. And then we will weight the main scenarios for March, how they will impact the price, how they will move markets, and yeah, I think now all is good. So what we can say about February, I think the clear way to say it, it was not a trend month, it was a transition month. We can definitely label it at some point as a stress test for some assets. And the big question now, are we moving to expansion or to stress? What actually defined February? There were maybe three or four major um, themes, but let me open first the commodity section on our platform, move to oil, add it to the charts. And the first thing to obviously highlight is the geopolitical tension. The tension between the US and Iran mainly. It escalated, and that was the main driver for oil to reach 6 month highs. Why did we see that? We need to know that 20% of the global flows go through Hormuz. So even a temporary disruption or the idea of that, or if military drills obviously were enough to inject premium into prices. And we do see a premium on oil right now. It's between $7 to $10. So in case we moved or we saw an escalation, and that's the major thing that all traders are checking at the moment. What happened to? Is there any new headline? The talks that happened yesterday in Geneva, how positive was it? And you can see it immediately being reflected on prices. You can notice here if we zoom in. Yesterday was brought us a little bit of a positive outlook for the talks between the US and Iran, and then we see oil dropping significantly. And then here where probably the technical analysis come into play and helps trader because you can see that this dropped was maybe stopped at this clear uptrend that we've seen throughout the new this year until today, where it stopped previous drops from moving or dipping lower. And then we saw a bit of a rebound, and today it's a bit positive as well for all prices. And we'll dig a bit more deeper into the technical part. But what you need to take into consideration at the moment, we're discussing a risk premium on oil prices, not a repricing. If in case we see any escalation that adds more pressure on that, then the premium can go higher. But to see an actual repricing, we need to see a disruption at Hormuz. Then we can definitely see, or we could probably see an immediate gap higher. From a historic perspective, whenever we had this geopolitical tension, oil historically moved higher by 18 to 20%, 3 months after a geopolitical shock. But historically, we need to know oil spikes tend to be short-lived and it disappears after 3 to 6 months. We saw that maybe soon when we had the Russian-Ukraine war. To put it simply, oil trades fear, but then it doesn't hold cheer forever, especially if we have to take into consideration that the major player of OPEC have the capacity to add a lot of oil in short term, and the supply was controlled artificially to keep prices a bit higher. So take into consideration all of these things into play. I think it's a very interesting month for oil, for traders, for long-term holders. It might be a different story, but why do we think it's the volatility might remain? Because there's a lot of maybe things to take into consideration from the supply perspective, from production perspective, from demand perspective. There's a lot of uncertainty around these three major points because when it comes to production, big players, as we said, have the ability to produce way more than they are producing right now in a short term, especially maybe GCC countries, the KSA as well. They need higher oil prices for their balance sheet, so they wouldn't mind producing an environment that would allow them to produce more while keeping prices at a higher level. Other thing to take into consideration is supply chain. Here's, I think, the main um, maybe the main stress, even if there was no disruption, but then the premium is might still be elevated for a while. Demand is also a bit more bearish. Outlooks are a bit more bearish. Demand from China seems like might be lower in 2026, and inventories are at full capacity. So these are the things that keeping oil testing a major level, and we're discussing now WTI or oil, US crude oil, around 65.5. That's a major level. As you can see, if we zoom out a little bit, this level, we've never seen prices trading above it since 7 months. Even when we did, it was like a small spike. And that level was a major, maybe psychological level for the downtrend. Once it broke, we saw prices dipping in a faster term. Then we tried to test it again, and it gave us back another dip lower. And then since Jan, this momentum that we saw on oil, mainly supported by geopolitical tension, also was stopped or tested multiple times this level. Then we had this break higher, and it was only because of a risk premium on oil, not a repricing yet. So that's also an important thing to take into consideration. Now we are retesting it again. Very important to see how prices will move from here. We did have positive feedback from the talks that happened yesterday, but today, supposedly, we would have a more official view from the US side, maybe closer to the US market close. So we're coming into the weekend. We might open on a gap on Monday. The levels that we need to check, even if we had a bit of a drop, is the lower level of the uptrend going to be respected? We have 64.5 as a major support we need to take into consideration on the short term. If it dips lower, then the next maybe support for bears would be at 62 or 61.9. In case it keeps on trading above the or respect the uptrend, then we might be looking at 68. We need a clear break above that level to continue or to see the bullish momentum continuing on the short to midterm. So that's the main, I would say, news headline that affected oil. Only at this point, we're not seeing it maybe affecting risk behavior overall. We're still seeing different news, different highlights affecting stock market, for example. The first thing we can maybe focus on right now when we are looking into indices is not the earning season, sadly, which should be the major mover for indices and stock market. We see how the market or how a certain stock is doing, how the company is doing, its balance sheet. But now we have other things. taking the spotlight. I'll zoom in on S&P 500 and we'll talk a little bit about the trade policy drama, if you would like to call it. So what happened last week? The Supreme Court managed to overturn the global tariffs that Trump imposed last year, but then Trump fought back with another global tariff with a different law and introducing like a different framework for that. So what do we take out of this? um, Uncertainty, and the markets hate uncertainty more than bad news sometimes. So, policy uncertainty is still here. It's actually dragging it a bit on a like a midterm level. Why do we care about this? Because businesses, supply chain, they are all getting affected, and they prefer clarity over what's happening right now. And yeah, that uncertainty matters. It affects traders, investors' decision. It affects capital flow. It affects definitely the global risk appetite. So we had a lot of volatility, as we said, in February. But if we zoom out, we can see that S&P is almost flat for the year. We had this formation, like a triangle formation. Usually, it should be a sign of a bullish momentum unless we see it breaking below it, and that's what we saw. Mid January, we saw a break below the formation. We tried to retest it, and keep in mind, whenever we have major breaks, markets usually tend to retest it, and we retested it again, as you can see, end of Jan. That was the main day, like the big drama day, with gold prices dipping. And then also prices could not regain this level and dropped back again. And this level around 7,000 is now the major resistance on S&P 500. Also, we saw another bullish momentum mid-Feb. We still couldn't materialize it to higher levels than 7,000. So overall, we have high volatility. S&P is flat for the year. If you want to take it also into perspective, how attractive the stock market in the US is compared to the global markets, usually it is very attractive, especially in times of uncertainties. If you remember 2022, when there was like a bit of a bear market, the US stock, let's consider that out of $100 global inflows, we've seen around $70 going into the US markets or the US equities. At the moment, it dropped to 26%. So it's relatively fading. Is it a good news or is it a bad news? We cannot really label it as such because also other markets are benefiting from it. So globally, the risk appetite kind of remains. And another thing also that we need to take into perspective is the rotation that we're seeing. Insiders are selling, for example, AI and big tech companies, and they're moving into retail strength. Some software are dead, yes, but we're seeing also some survivors selectively. Um, the worry is if we see momentum breaking, especially for crowded positions, and that would be a stronger story for Nasdaq. But let me just show you briefly Wall Street, and you can see that Wall Street is still respecting the uptrend. So we're seeing a sideways movement, yes, but from technical perspective, Wall Street is stronger. It has a stronger bullish signs. But then if we look at Nasdaq, for example, we can see it trading since October. We can consider it as a sideways movement. Um, since also the big day of end of Jan, we saw a bit of a pressure on it. We're definitely seeing a repricing of AI. I wouldn't consider it as an unwind, but that's probably a high risk to take into consideration for whoever have exposure on the tech sector, especially if we look into the ETF investors. Over 50% are exposed to tech, so it's a little bit a crowded position. I don't think it's a collapse setup, but it's a fragile setup. From technical perspective, we still are on a sideway move. Maybe local supports and local resistance might be tested and retested until we have a clearer view. I think it's probably a clear trade or a clearer trade for traders than long-term holders, but March is usually positive for stocks in case we don't take into consideration trade war, geopolitical tension. Usually March is positive for stocks. So that's the quick look that we have on the stock market. An important thing to take into consideration, we are seeing a rotation more than an exit. Um, Let me check in case we move to gold or we move to Bitcoin. If you have any questions, please feel free to ask. Um, but let me move to commodities, back to commodities, and we'll move to gold. And I just added one line. We'll try to maybe explain more the technical setup. And if you have any questions, please do let me know. So as we saw in Fab, gold dipped below. I'm just reminded that we have 5 minutes, but we'll try to make it fast. So since early this year, we had a strong momentum on gold. And as you can see, I kept this uptrend even though it was broken because it's really important to take it into consideration. So I will add Fibonacci retracement. This big bullish momentum brought prices to 5,600 mainly because of retail traders trying to catch up. It was a FOMO trade, and then prices dropped to almost 4,400. So we're talking about like $900 drop, but it was short-lived. We then saw a relief, and then we can see why this uptrend is back into the spotlight technically, because it is now the major level of the markets are trying to test as a support and as a resistance. It's continuing to try to test it. Even this major, maybe bullish momentum that we saw since mid-February till today, it was stopped at 5,000, around 5,225, and that's where it tests the lower level of the previous uptrend. And now we are moving between two major Fibonacci retracement of 61.8 and 76.4. So it's 500, 5,140 and 5,300 respectively. We might see prices moving in this short range until we have a major catalyst. I think it might be soon. Depends on what's going to be. It's going to be maybe highlighted today from the US side and throughout the weekend. Silver have almost the same move, but we need to know maybe the fundamentals behind this move. What's worrying us about gold is that it's the most crowded trade, the most crowded. And what do we mean by that? If we look into gold again and we go to the monthly chart, we add RSI, which shows us how much of the market participants are already bought or sold. We are above 90. That's not a normal number. Usually we speak of an overbought condition when it's above 70. So imagine even in it's we I don't even know if we can say rarely or never saw this kind of a crowded trade on a monthly basis. So that part worries me. Maybe if we can try to compare gold to oil, I would say oil is probably a bit clearer for traders, but oil might be uh, less volatile, less risky if we hold for a longer term. Um, Shanghai vault inventories are at record highs, so that's the positive. Chinese physical demand still at at all times high. Geopolitical hedge, monetary hedge still major supporters for prices. Oil shock, by the way, usually helps gold as well. So in case we saw any major shock in oil markets, gold usually after 3 months moves around 6% higher. In 3 months, in 6 months, it moves around 20% higher. So that's something to take into consideration between this um, maybe link between oil and gold. We are in, I think, in a sideway on a short term, but on a long term, we are at a breakout zone. So a continuation is likely, but volatility also remains. Just keep in mind it's a crowded position. So in case of any major move or new catalyst, volatility spikes are very, very possible. So we'll look into Bitcoin just because we don't have a lot of time, or silver. I'm not really sure which one we should go with. We'll do both quickly. So let's look into silver. Silver kind of have, or usually historically, uh, follows gold in its moves. It outperforms, especially when tariffs are the major scenario or the major headlines, because as we said, it's the effects are or the asset itself is a hybrid asset between industrial and between monetary hybrid. So in case there's any news affecting industrial metals or industrial commodities, it would support silver. Tariffs, sorry, support silver, and at the same time, monetary policies, geopolitical tension also support it as a way of hedge. But we need to remember it is a beta asset. It might be even more volatile, aggressive in its moves. But those who are looking into local resistance, we have 94.7 as the local resistance. The good sign we're seeing technically is the moving averages back to giving us a sign of a bullish momentum. So keep that in mind, but also keep in mind that silver usually is more aggressive in its moves, but also March is very positive historically for um, industrial metals. We'll look at Bitcoin, and then please remember, even when we are done with this live coverage, the session itself remains. And in case you have any questions, you can write it, and we'll make sure to try um, and answer you back. So if we look at the weekly chart, we can see that this week was still, yesterday it was a bit positive, but today we're back into red. Let me just try. The positive thing to take into consideration is that we have big whales buying the dip. In the previous 3 days, we've seen over 200,000 Bitcoin being purchased by big whales. And even though we've seen huge outflows from ETFs, at the moment, ETFs still have $53 billion net. When it first started, we assumed it's going to be around 5 billion. So still, that's something really positive. Jane Street, for those who are following, the second largest uh, ETF is buying. It bought, and then there was some rumors that it was the main mover of the markets, was manipulating the market, selling at 10 a.m. every day. But since there was a lawsuit filed, it stopped. So that's something also that might be positive from here. Why am I highlighting? And there's a lot of colors on this chart, but why am I highlighting this part? That's the previous all times high in 2024 between 58 to 78, or 58 to 70, 67, sorry. And now we are retesting this level. A break below that might be really risky. Hashtag, by the way, recovered. We have a V-shaped recovery for the hashtag after February drop, but then in case prices drop even more, then it might be even not profitable for miners anymore, and that's the biggest risk. So we might see prices moving back or retesting the sideway, just like we saw it retesting it in 2024. We're seeing a bit of the starting of some bullish signs technically. RSI already dropped to an oversold area, so that's usually also a positive sign. But then what we are seeing, especially gold moving higher, oil moving higher, stocks, okay, there's some of rotation, sideway movement, but then crypto being sold off this aggressively, it actually challenged the scenario that crypto is a hedge against geopolitical tension. But I think the major thing to consider is that it is a highly leveraged trade. And that's what's being unwinded right now, whether it was a high position, high leverage position in gold and maybe AI and tech and crypto. That's what's being tested throughout February and not an overall um, risk off sentiment. So hopefully you take these things into consideration for this month. I don't think market is trending in one direction. There's definitely a rotation. The key questions are: is this uncertainty because of a risk appetite is off, or is liquidity just waiting on the side to see where it's going to be injected again? If oil stabilize and gold holds higher, then equities might also continue its uptrend. But if oil accelerates, gold breaks aggressively, then we think volatility will spread. And usually that's what scares investors, especially long-term investors, but that's what creates opportunities as well for short-term traders. Keep in mind, you can always add your questions even once this stream ends, and I will definitely see you next month. You can always check our analysis on our different platforms or on our website, on YouTube, and we wish you a great trading month.